morning, everyone, and thank you for joining us for the Pengana Australian Equity Fund update with Brett Kessler. My name is Brett Gear and I'm a member of the New South Wales distribution team. Now, for those of you who've joined these sessions before, you'll know the update at this time of year is a focus on the reporting season that we've just had. However, with so much happening across the globe at the moment, inflationary concerns, interest rate rises, political tensions, war, today's update will be an equal focus on global macro and how the results of the recent reporting season also are shaping Rhett and the team's decisions around portfolio construction and stock selection. It's also a good opportunity, I think, to hear from Rhett and answer some questions that you also may be getting from your clients on their portfolio positioning at the moment. Rhett's going to speak for about 20 to 25 minutes, and we'll follow that with a short Q&A. So please type your questions into the question box and we'll endeavour to get to as many as possible. And with that, I'll pass over to Rhett. Thanks, Rhett.
For your attendance. As Brett mentioned, I'm going to cover a number of things, including the portfolio's performance, what's actually happened this year, what our views are going forward, and then how the portfolio is shaped to take care of these issues. On our first slide, we always try to put a picture of what's our thought process is and what's bothering us. Those of you who attended last presentation will remember we had a picture of a whole lot of bubbles. Many of those have burst, and so we've moved on past that. The thing's really focusing our attention now, and I'm sure it's consistent with some of your thoughts and processes, particularly coming in from your clients, is inflation. The inflation has arrived. And certainly we think central banks will have a hard time controlling inflation using interest rates. And remember that some of them, particularly the US, have got bloated central bank balance sheets, which they have to contract at the same time. Without getting too macro, I just want to try and draw a very clear distinction between what's happening in the US and what's happening in Australia. Now, many commentators, I think, are confusing the two. We certainly are following similar trends, but there are some fundamental differences, which means that, once again, I feel like I've won a lottery ticket to be in this country because I think we're much better placed to deal with inflation. We have a much better fiscal position and therefore don't have the same quantitative easing issues. And we don't have the same runaway inflation. We do have inflation, though. So let's jump into it. Obviously, there's an important disclaimer. The team has stayed the same, so I'm going to skip past that. This slide has been consistent for the last 15 years now, where our focus remains on maintaining the real value of money in Australian dollars and generating a reasonable return. We have added, for the first time, a line on this slide, and it's really because our clients have been asking about, inflation. And so on a semantics basis, we think a good way to address that is to say it's about preserving and growing your purchasing power. And that's become a much more important issue for everybody after 30 years of stable inflation, with inflation returning. In terms of the performance, look, we've consistently done reasonably well. No one's more cognizant of the fact that we didn't start the year particularly well. We've got some work to do in catching that up and returning to positive territory. It's been distorted a bit by the massive boom in commodities and energy stocks, which we have some, but we're not big participants at all. When we know we have some work to do, and our stocks have bounced quite well recently, and we suspect that we will return quite soon. In terms of the longer-term performance, fund's in good shape, but as indicated by that blue line dipping below its previous peaks, we have some work to do, and we're very aware of that. So what are we thinking? And what's happened calendar year today? It feels like a lifetime after the first quarter, but certainly we got a great window into the economy. And it's very clear that the strong are definitely getting stronger. February corporate reporting season was surprisingly resilient and certainly validated a lot of our investment thesis. This The fact that the companies we own have paid very healthy dividends, and you'll see that illustrated later, has certainly provided further confidence. Fortunately or unfortunately, I mean, we've been correct about predicting inflation. We said this is not transitory, and it's certainly arrived much stronger in the States than Australia. But essentially, one way of thinking about this is that, for me, inflation is certainly just when more and more money chases the same or less amount of goods. And I guess what's unusual about inflation this time, and a good lens to view it through, is that the stimulus has provided, and cheap money and government handouts has provided an enormous amount of money in the system, or liquidity in the system. And that's created a lot of demand. So inflation is demand driven. However, at the same time, there have been significant bottlenecks created by supply chain logistics, whether it's absenteeism due to COVID lockdowns, whether it's war, whether it's containers in the wrong place, whether it's simply just not enough investment in computer chip manufacturing plants. These supply chains have created a real tightness. We think the portfolio is really well positioned for this because we're predicting it for some time. But bear in mind, there's going to be some dislocations. And essentially, how you manage inflation is when you have companies that have pricing power, so the ability to pass through successfully higher input costs to your customers. And importantly, you need inelasticity of demand, so that when you do lift your price, volume doesn't dry up. And then thirdly, something that's not well thought through generally, is you also need a very robust balance sheet. Because if you're doing all those things and you're carrying working capital, and the cost of that working capital is going up, you need more working capital to cover that. And so robust balance sheets are quite important. Certainly, we didn't predict the war in Eastern Europe. And one way of encapsulating this, one of my peers put it this way, he said, when you get the second or one of the world's largest energy producers going to war with one of the world's largest wheat exporters, you get real problems in the commodity supply chain. Now, very, very comprehensive sanctions have been placed over Russia's ability to export all those commodities that it's kind of famous for. And certainly a country at war might have problems during its planting season for the wheat crop and all the other crops, and may have problems exporting. And this has created real issues within the commodity complex. Now, unfortunately, you don't want to make or benefit from a war or country's misfortunes. But certainly Australia is perfectly placed to benefit from these higher commodity prices, and probably for 3 or 4 reasons. We all know about the iron ore, we all know about the coal, but certainly LNG has expanded to our ability to produce volume has expanded to the extent that we're definitely in the top 5 exporters. And secondly, our ability to export soft commodities has been helped by 2 years of extraordinary good growing conditions. And so our volumes are at record levels. And that has put us in an exceptionally good place. So we've shown this slide for a while. I'll point out only 2 things. I mean, this is the 300-year cost of money proxy, which is the US Tenure Treasury bond. It's extraordinary that certainly my generation, and I'm just under 60, has had 30 years of ever declining interest rates, which has created a credible base for building an asset base. Unfortunately, I don't think that's going to be repeated for some time. So that's the first thing. I think it's going to get harder. And secondly, we have a view that interest rates will move up. Now, bear in mind that we have lots of clients who, for years have been telling us, Red, I'm not sure, what you do, but all I do is I buy property and I buy shares and I hold them for decades, and they go up in value. And certainly when you have ever decreasing interest rates, the cap rate continues to compress, which is how you value property. And certainly the same is similar for equities. So we feel that recalls the fact that we don't see this ever declining interest rate environment continuing. It's going to create a very different way to make money. And we think the way to make money going forward is not buying tech stocks that won't make money for 5 years and having their cap rate on revenue of, revenue times, sales multiple for your valuation going up all the time. We don't think that's the gig anymore. We never have, but we don't think that's gig's going to play out in the market anymore. We think a better way to make money is to buy companies with very high after-tax cash earnings yields and harvest that money going forward. And we certainly feel that's the way to do it. Look, this curve continues to change. It's the shape of the yield curve. The current yield curve is in blue. A year ago, it was the orange. It's, a week ago is the blue curve. It's gone steeper. It's hard to keep this curve up to date. But two things, I guess, the cost of money is already starting to move, and I'm going to demonstrate why I think that's got a long way to go. So higher interest rates. And secondly, I think that that you should be cognizant that 3 to 5 years out, it starts to flatten out. And if you think that bond guys are smarter than equity guys, which I certainly do, that indicates that maybe a recession is coming. Maybe, not definitely. We've had 30 years of stable inflation. I do want to point out that this is a US chart. The Australian chart is similar, but doesn't go up to 7.5%, goes up to 3.5%. Right? So fundamentally different. The US is certainly spiking, and we think it will continue to go up. Importantly, though, after 30 years of stable to low inflation, many people have never experienced inflation. And therefore, even someone like myself who has 25 or 26 years ago in South Africa, it's a long time ago. And everyone's trying to move up the learning curve quite rapidly. One other thing I wanted to just show, this is a complicated chart, but essentially it's fascinating to me because it indicates the spread between PPI and CPI. So PPI being inflation amongst producers and CPI amongst what the producers pass on to the consumer. And so the one minus other, when you get big red charts, it means that producers to date, certainly for the last 3 or 4 quarters, have absorbed a lot of that increased inflation of input costs. And so even if this commodity complex does come off the boil, there's still a lot of inflation to flow through the system. And that's the reason I show this chart. This is probably the most sobering chart. And we put this up at the last webinar, and I think the one before. So what we've done is we've kept the one that we had in June 21 up, and we've put a new one up, reflecting the current environment. So we just go back to June 2021, refresh all the countries we like to follow. We've highlighted Australia and the US. They're equivalent to the RBA cash rate, what the rate was in June 2021, what CPI was back then, and then effectively what your real interest rate was, which is the result of the two. And then we also added for good measure whether it was a cut, the last move was a cut or a hike. And you can see that most of them were green, and we were saying that, in the depths of a pandemic, stimulus was all important, and so central banks were certainly trying to jack up interest rates. And we predicted that when we came back that all those greens in terms of cuts would likely turn to hikes, because having an impost of high negative real interest rates is not good for the economy and is unsustainable. And so now when we switch to this chart, we've still got it in the same ascending order of what the central bank interest rates are. You can see that there've been a lot of hikes. But the other thing I would point out is that inflation surprised even us. And so with much higher inflation, central banks have a lot more work to do to get to a neutral or even a real interest rate setting. And so the US is almost -7%. If you just think about what that means if you want to take no risk and put your money in the bank and earn in the States maybe 0.5%, as much as 0.5%, you are going backwards by 6%, 6.5% annually in terms of your purchasing power. And so we think the US has got a lot of work to do. Australia's got some, but you can see that we're not as badly affected. And bear in mind, the US has to go first. It has to lift and create this umbrella that everybody else can lift, because everybody's trying to manage their currency as well. So in very clear terms, our prediction is the US will go up by 50 basis points in three changes, probably sooner than later this year. The fact that they have to try and shrink their balance sheet at the same time worries us. It's never been done before. And we suspect they might put a hold on shrinking their balance sheet, but they're certainly going to have to move their interest rates. And then Australia will move up as well. And we think that maybe 3 hikes of 20 basis points is probably coming. A neutral setting for Australia would be 1.5% to 2%. We're a long way from that. But certainly we think the economy can hold it. I'm going to flick through these charts and go straight to, so how did we enter the year? So I want to highlight that it was a very defensive portfolio, lots of beige making up 50% of the portfolio, lots of financials, and for the first time we have more resources than consumer discretionary. Now, it's not a punt on resources. We haven't changed our spots, but for a long time we've had Evolution Mining. We've traded that quite well. We use it as a way of accessing gold for its inflation protection. We found a company that's the lowest cost producer of gold, so the lowest cost gold factory, and management's good. And most importantly, we can buy them on decent after-tax cash earnings yields. And then we have mainly BHP because of its high after-tax cash earnings yield. In terms of the put options, I do want to cover off on these. Our last tranche that we had expired on January 20. We were, with increasing activity, trying to replace them. From about mid-December to about mid-January, the cost of those puts went through the roof. Volatility was really high. Generally, we buy them around a 16% vol. They were up at 23, 24, and we struggled to own them. And so we have a very rigorous process. We worked out that the market would have to fall by over 10% for us just to break even on them. And so reluctantly, we let those expire without any additional. Obviously, in the first week following the expiry, we were kicking ourselves. But in hindsight, our process worked and we would have got whiplash because the market bounced so quickly, and particularly resources and energy stocks were very strong. And then our cash level was 5%. I do want to point out that the stocks we had gave us an after-tax cash earnings yield of 7.2%. So what did we get right? Telstra, we've spoken about a lot in these webcasts. It's done very well for us, and it's an incredible beneficiary of inflation. Financials, particularly NAB, which is our biggest holding, and CBA, and we have several diversified financials, they will benefit from higher interest rates. Our health insurers have large pools, also likely to benefit, and then we've spoken about commodities and resources. What the jury's still out on is some overseas companies that do have buying power, pricing power, do have inelastic demand, and do have resilient balance sheets. Aristocrat, Amcor, Woolworths, and I probably put ResMed and CSL in that space. What we got wrong, absolutely, we didn't have enough cash. We thought that an after-tax cash earnings yield of over 7% in an environment with a negative real interest rate would be sufficient to guard against a drawdown. We were incorrect. When the call for liquidity came, the sell-off was enormous. And it was complicated by the fact that BHP went from under 5% of the index to currently about 12%. And there was this rush to sell everything and buy BHP, which certainly hurt our bigger holdings. The fact that we didn't have put options, and then we had some less liquid small caps that had much higher share price volatility due to their lack of liquidity. How we came out of it, underlying cash flows remain intact. We've been through every model with a fine-tooth comb. There's no rubbish in the portfolio. They're all really good companies, and we think we're likely to keep their straps. After-tax cash earnings yield is now above 7.5%, so we think extremely well placed. We did have a larger than usual participation in the market correction. Certainly, exaggerated by the fact that commodities had a massive run. I'm going to skip past our process because I think everybody is familiar with that. Certainly, it hasn't changed. And there is one slide that I do want to focus on, which is this one. Essentially, we look for good companies. We have good idea generation. We define what is a good business. And then the magic thing at the end is, can we buy it at the right price? And for that, we use an after-tax cash earnings yield of at least 6%. That's the amount we can scrape off, put in our pocket, walk away, so we can come back and scrape off more next year so we don't damage the business, so we can come back and scrape off more. And I have never seen the after-tax cash earnings yield of the portfolio this high, and it generally is an inflection point. So where's the portfolio now? And I'm going to skip past these, given that I've probably gone on for too long. Right, okay, so that slide's not there. Apologies, there should be a slide showing the portfolio. So where the portfolio is now, it is fairly similar, very similar. Still got 50% in well-diversified companies. The two changes is cash is up at about 7.5%. That is as a result of those high dividends that I've spoken about, where we harvested dividends. And secondly, we have, given volatility's really fallen, in the last few days, we've bought puts again. And so we have a 3.5% negative exposure, notional negative exposure. It's cost us 0.2% because vol's really come down. And so the portfolio is quite defensively placed. Probably most importantly is that we have an after-tax cash earnings yield closer to 8% at the moment. And that stands the portfolio in good stead. So a couple of reporting season observations, and then I'll go back to questions. The underlying earnings remain really strong. So it was everything about the reporting season highlighted that again, feel like I've won a lottery ticket to be in this country. There's lots of stimulus. There's over $250 billion of excess savings sitting in people's bank accounts. We do have a record low cost of debt that's due to go up, but we think consumer balance sheets are well placed for this. Consumers on home loan mortgages are almost 3 years ahead on average of their repayments. And the domestic focused economy, demand levels really high, are generating really high reported earnings. The terms of trade are enormous, and wage rates, employment levels are exceptionally strong. We think that wage rates will move up. However, two negatives. The first one is that everyone's changed from just-in-time inventory management to just-in-case, and that's requiring a robust balance sheets because it's sucking in cash. I've referred to that earlier. And the second thing is that labor costs, but more importantly, availability is becoming an issue. I don't think there's ever been a better time for kids to enter the workforce. I've got two coming in, and the opportunities are enormous. I remember 2 years ago when we had our internship program, and we offered, I think, 3 or 4 spots. We had 220 applications. Retailers are telling me they're trying to fill 10 positions. They're getting 1 application. Now, we're tracking migration and foreign students, and that started to pick up quite sharply, but we think it'll be a slow burn. So this is the double-edged sword. On the one hand, you've got really high employment, and probably wage growth will be quite high. But on the other hand, it's creating another driving force for inflation. And so the assessment of risk for predicting cash flows is really high. Remember in 2020, when we deployed all that cash into the market, we had high confidence because when we looked back to see what the companies were capable of, we only had to look at 2019 to see what a normal year was. We're now in a third year of non-normal. And no one really knows what normal is anymore. And the way we're managing that is very conservatively. So we have low valuations that we're applying to the companies, underlying cash flows, and we're also demanding a much higher after-tax cash earnings yield to get comfortable with the business. It's a margin for error. So on that note, I will end it there. And I'm going to stop sharing and go back to, or maybe, just go back to questions.
Thanks, Brett. We've had a few questions started through. If you've got any further ones for any of the attendees, just in the Q&A box down the bottom of the screen. Brett, you kind of half answered this in the course of the presentation. You mentioned you think 3 moves of 20 basis points for the RBA, but the question that had come in before you actually mentioned that was when do the rate rises start domestically? How fast and ultimately how high do they go?
Look, unfortunately, my crystal ball on interest rates is not perfect, but our assessment will be that first of all the US has to go. Secondly, I think it would make sense for everybody involved to delay it until after the election. Now I know I've just gone blank on the Reserve Bank of Australia is supposed to be politically independent, but I suspect they'll wait. And even if they go before, I suspect that the big 4 will hold over until after the election because they want to repair their social license. So first move we see probably early June, if that makes sense. And then I suspect that the US will go and then Australia will go in two successive increases thereafter. The really binary outcome that I think we need to acknowledge is that if we had to see, every morning I wonder if I'm going to wake up and I'm going to see that there's been assassination, that there's been a coup, that there's been a cessation of hostilities in Eastern Europe. And the impact that will have on the commodity complex pricing, I think will be enormous. And for 2 reasons. First of all, I think that particularly the former 2, so a coup or a assassination, I hate using that word, but if those 2 happen, then it's much more likely that sanctions will come off sooner rather than later. And suddenly this enormous energy volume will become available, and that'll have a real impact on share prices, on commodity prices, and then share prices. And that's why binary action, we're not going to change our spots. We're not going to start chasing this commodity complex of stocks in the market. If that happens, it does significantly change the terms of trade for Australia. So every week that goes past at this level, we just get enormous money, which if I can just, sorry, Brett, just divert because I think this is really important, is that the terms of trade are so positive. For decades, we ran a deficit, and therefore the big 4 banks went offshore to fund the fact that our credit growth was higher than our income growth, and that translated its way through the mortgage market. I think we really have to acknowledge that these massive terms of trade are pushing enormous amounts of money into the country, making our income growth bigger than our credit growth. And that has an enormous stabilizing impact on funding our mortgage books. And so, we are looking at through a lens that maybe is a bit outdated and how it, always flows through to higher interest rates and the impact. We have optionality as a country, and that's why, we've all won the lottery ticket to be here again. So I've spoken for a long time. If I just summarize, because I know when people ask me a direct question, I should give a direct answer. Interest rates unlikely to move before the election. Banks more unlikely to respond before the election. And then moving up to a reasonable, still below 1% by the end of the year. Hard to say where it's going to fall because of the unknowns, but certainly in 2 years, I see it closer to 1.5%, which is a neutral setting.
Thanks, Brett. I'm just going to combine a couple of questions here because I think they're on the same theme. In this environment, what keeps you awake at night? And as an extension to that, what are you more concerned about, global inflation or military tensions?
Look, there's always stuff to worry about. We've always said, things are really interesting, and I can't remember a time in the last 15 years that hasn't been interesting times. It does feel that the word unprecedented gets used an awful lot, and most of it's correct, right? I mean, I've used it a few times in terms of trying to contract balance sheets as well as lifting interest rates for the US is unprecedented. So what keeps me awake at night is and it's a very small chance that the hostilities expand into other forms of warfare. That would keep me awake at night. And the reason for that is obviously the human cost, but also the impact it will have on the global economy as it affects our portfolio. There's always a chance that China might do something while everyone's distracted by Russia, but I do feel that the response globally has been so strong that's been put back in its box. But what do I know? And by the way, every single investment bank out of the US is running almost weekly narratives or conversations, question and answer sessions with NATO leaders and ex-secretary of defenses, etc. And we've been very lucky to get access to that. And it does feel like there's a coherent plan to keep everybody in their box. So I don't spend a lot of time worrying about that. It's out of my hands. What I do worry about is the impact this is all having on globalization. So it's unwinding globalization. And the impact is directly affecting supply chains. And that's, even though you might have the world's best mousetrap and you may have enormous demand and you've got great distribution, you just can't fill the demand. 2 examples. Wheat farmers are getting really wealthy. Second awesome year. Our channel checks show that if they had another 10,000 Mercedes-Benzes or Porsches in the country, they could sell them. Just can't access them, right? ResMed has the ability to go to 90% market share from 40 to 50% because the FDA kicked out Respironics, their major oligopoly competitor. They're grabbing another 10 or 20%. They just can't get enough computer chips to double their output. Ain't going to happen, right? So supply chain really worries me.
Actually, sorry,
inflation.
While you're on that theme, it does tie into one more question, and this will be the last one on the macro because there are a few more about the fund and stocks. Raising rates globally too quickly, supply constraints ease. As a consequence, growth is squeezed. Then we find ourselves facing potential stagflation or even a recession. Question.
Well, I remember a year ago talking about inflation and even stagflation, and it's like the big, it's almost like in Harry Potter when they don't mention Voldemort, you don't want to talk about it. Unfortunately, that's become a logical outcome. The bond rates are telling us that economic growth is not going to be great. And then the inflationary pressures look like they're here to stay. So what is stagflation? It's low growth and high inflation. It is incredibly debilitating to purchasing power, incredibly debilitating. I watched a whole generation in South Africa get impoverished. And can I just say that we have spent an inordinate amount of time going through our portfolios and thinking about that. So think about what is the current theme in our portfolio. And it is a bit boring. There's a lot of beige in there. But just think about what it is. It's pricing power, right? And pricing power comes from 2 things. One is the ability to force, to keep input costs lower, but if they do go up, to force them through successfully. And one of the main reasons is that you've got sunk costs. And so you don't have to worry about inflation going up. So if you think about a Telstra, the infrastructure is built. The tower costs are not going to go up if inflation hits. Then the second thing you want is inelasticity of demand. And the things that we've got, like a Woolworths or a Telstra mobile phone, mobile data, are 2 of the most inelastic things around. So if prices do go up, volumes won't drop away. And then third thing is that you need the balance sheets to manage the output. So we thought, we thought long and hard about this. Can I just say, without scaring anyone, I don't think it's a 40% chance or even a 20% chance, still down in that less than 10% chance. But we do think about it a lot and prepare for it.
We'll bring it down to back to the fund now and stock specifics. Were there any, given the, I guess the offshore earnings of the fund, were there any sort of unintended exposures to areas like Russia, Ukraine, any revenue streams out of those regions?
That's a great question. So we have two direct exposures, and then there's obviously some other exposures because of the globally linked supply chains. But the two direct ones are Amcor, which is in our top 10. It has 3 factories, 2 in Russia and 1 in Ukraine. And the 1 in Ukraine is really small, and the 2 in Russia generate about 2% of the group sales, and they are more profitable because they're in tobacco cartons and they're higher risk, so you'd expect them to be profitable, more profitable. So, capped out at about 4% of EBIT. So we've ring-fenced that. They are closing them down. Everyone said, could they get nationalized? I've been asked, can they get nationalized? The bottom line is they effectively supply the companies, the global international companies that have themselves shut down. And that's why, shutting them down is just part of the whole sanction issue. So, yep, they could get nationalized. We've written them off in our models. It's not that significant. The other direct impact has been Aristocrat has 1,000 employees in Ukraine. Now, that may seem like a lot. It's less than 10% of the company's workforce. It's directly in Pixel, the online gaming business. They've been running buses and setting up alternative work areas in Poland, and they've moved at least the workforce across. The other half have chosen to stay, but this has been an amazing exercise. The company said it won't be significant for their earnings. Most of the earnings come from the West, so we think it will have an impact, but it will be immaterial. And then the other things that are worth thinking about is anybody with exposure to Europe. The euro hasn't been that strong, and that will obviously soften, earnings across that complex. And you have, Amcor again, maybe a ResMed, maybe a CSL, but they're all well within in reasonable bounds. It's not that significant. CSL has a flip side. It produces a lot in Europe and sells most of its stuff in the States. So there's always swings and roundabouts in geographically diversified businesses. The main impost is on supply chain logistics, which are pretty tight before the war and a little bit tighter after the war.
Beautiful, thank you. One I'm guessing is in relation to Ryman Healthcare, but it's more generally about your thoughts around the retirement village aged care space now with the black swan event, not only of COVID, but the following, sort of supply chain issues, labour shortages. Has it changed the way you view the space?
No. If anything, what we've found is, we were worried that if the pandemic was particularly virulent and have a high mortality rate, and I'm sorry to be as mercenary, but sometimes you have to think about this, is what if it goes for CSL as well. Like, what if it kills off all their customers, right? Because their customers are more vulnerable, either being aged or requiring immunoglobulin, etc. And so we went through that whole process. That has not occurred. If anything, for Ryman, what has happened is people have realized how important it is to have vulnerable people in a controlled industrial strength environment that creates a safe environment where at scale you can manage things like access control, feeding people in a controlled environment, and and reducing the risk of them actually catching COVID. And so what we've seen is, as we've come out of COVID, people have, the carers, particularly the family of elderly people, have rushed to take advantage of the offerings of Ryman or Estia or Regis or any of the aged care facilities. One of the positive for humanity but negative outcomes that the last 12 months has actually shown is that normally turnover rates, and I hate talking about this stuff, but turnover rates due to mortality because of flu and winter, particularly during the winter, is what drives a lot of the turnover and therefore the earnings of the business. Very similar, in a much more mortal state when you're talking about funeral parlors, but as people move through the centres, particularly the high care beds, that creates turnover, which is profitable. But given the low mortality rates of the flu season last year, and maybe potentially this year, that has slowed the turnover and stopped the turnover. So there are lots of complex things. Can also say that certainly one of the positive outcomes from the budget has been that just to move to better things, has been that the government, both sides, both parties, have made a concerted effort to buy the grey vote, and they've thrown enormous amounts of money at aged care, and that's quite positive. The real concern about Ryman is the impact of higher interest rates on property prices. That is the biggest single concern. Now, historically, Ryman, Arvida, and all the other Somerset, all those companies have done extremely well with falls in house prices being just a speed bump. There's a massive margin of safety between what houses go for in the surrounding areas, which facilitate people buying into the new villages. And so we're fairly sanguine about that.
Beautiful. Thank you. And one last one, we might, just in the interest of time, make this the last question. Now, we saw Aristocrat raise money last year for an acquisition that fell over, which diluted their shares. Do you think this puts them in a good position with a strong balance sheet now, or do you think they will return this cash to shareholders?
Yeah, sometimes you get lucky and you dodge a bullet, right? Particularly with the prices of those companies falling as much as they have, the potential target companies. So the fact that they raised money, didn't spend it, they're going to develop their own RMG or real money gaming unit. So I think they've dodged a bullet. I think there are extra shares they have to service. While the land-based casinos are doing incredibly well, we just saw something this morning up 10% on pre-COVID levels. So unfortunately, it's an incredibly resilient industry. I say unfortunately because gaming is in a controlled environment has always been very resilient. So the direct question is, do I think they'll give it back? No, I don't think they're going to give it back. I think they're going to either spend it in buying something a lot cheaper or spend it in developing their own facilities. But certainly this is the time to be cashed up for growth, given that a lot of their competitors are quite extended. And so I think it places them in an exceptionally strong position. And I think, in a year's time, we'll look back and say the strong just get stronger again.
Beautiful. Thanks, Rhett. I think in the interest of time, we might wrap it up there. We generally like to do sort of a half an hour of an update and then about 15 minutes of Q&A. So we might get to any sort of other questions, unless, Rhett, you want to make a couple of just a quick comment on JB Hi-Fi and its re-inclusion in the portfolio.
Yeah, so it's going to be a funny answer for that one. Thanks, Brett. So we bought JB Hi-Fi and then they came out with their earnings upgrades. It rushed right up. And we realised that although we'd only got half a position, we weren't going to buy at those higher levels. So that was one that we said, well, we'll release the capital and keep it in cash. So we actually sold it, made a nice turn on it, but not the way we generally like to. We don't like to make 20%. We like to make 20% in a couple of weeks, but we prefer to hold them forever. And it just got too expensive too quickly. I do want to say that we have a very boring portfolio in that the after-tax cash earnings yields are really high. We're not buying things that we think we can flick in the future. We're buying things that competent management, absolute quality, and we think will do exceptionally well through this difficult period.
Beautiful. Thanks, Red. I was going to ask you for a little closing statement at the end there, but I think you've just made it. So thanks very much. We actually do, as you all know, we do normally get you through a recorded copy of this webinar, which we will, but there is also sort of an 8 to 10 minute version of Rhett's presentation, which is sort of succinctly cut down. And that, I think, is something that is very powerful for you as advisors and clients to have on your desktop, and just sort of really helps break down how this global macro environment or how this recent reporting season funnels down into portfolio construction and stock selection. So we'll make sure that we get you through a copy of both. Thank you, everyone, for joining us this morning. And please also do join us next week for our Emerging Companies Fund update with Ed Prendergast. Thanks very much. Thanks, Red.